Morning, everybody. Welcome to Phillip Securities Research Weekly Market Update. This week we're going to introduce our outlooks for other indices apart from the STI for the benefit of our CFD and ETF clients. Okay, so we'll start with the outlook for markets, then we'll go on to, as usual, Derrick updating on equities, and Ken is going to talk about banks and UOB. Disclaimers. Okay, those of you who have been looking at who have been watching our webinar for the past for January and December, we usually start off with a single slide on the macro outlook. So as usual, we are still progressively positive on the investment climate for this year, and we think this is a year to favor stocks over bonds. Okay, global growth is picking up in the industrial nations. ASEAN growth this year will moderate from last year but remain resilient due to infrastructure spending. Our macro team is forecasting a pickup in China, Hong Kong, and Singapore. Fourth quarter GDP for China was above expectations at 7.9% year-on-year and met our full-year forecast of 7.8%. For this year, we're forecasting 8% for China. And we're also forecasting that Hong Kong and Singapore pick up from last year. Okay, risk assets are supported by quantitative easing, mainly, or threats of quantitative easing from G4 central banks. That's the Fed, the ECB, Bank of Japan, Bank of England, all have some form or other of quantitative easing or threats of quantitative easing. And this should support the downside for risk assets, which is equities, high-yield debt, and commodities. Okay, globally, monetary policy remains very loose, and inflation expectations are anchored. We expect some kind of rate normalization, but nothing excessive, and policy to err on the side of growth generally. Any rate raising now would be worse for bonds than equities, and we think that even if there's an end to QE, there might be a flight from bonds to stocks. We maintain overweights on China, Hong Kong, Singapore. Generally, these three countries have very low earnings expectations, yet growth this year should be better than last year's. Valuations are not yet normalized, and technical trends are good. And last week, the S&P 500 broke the 1470, and the HSCI broke through the 12,000, which I will elaborate in the slides later. Some positive catalysts for this year, which is China reforms. We're expecting that in April. And we think that reform is in the air in China, and which is mainly to address income inequalities between rural and urban. And we think that such reforms would impute more confidence into China's growth story. Other catalysts could be Spain activating the OMT, which would basically cause the market to breathe a sigh of relief and put Spain in the rear view mirror. And I think this year we're going to see some earnings upgrades. Key uncertainties would be the sequester and the debt ceiling. The Fed could get cool over QE. And also the Eurozone has problems. The underlying problems of the Eurozone are still there, but more or less papered over. Okay, this slide here shows our asset allocation strategy. So last year, we were more positive on bonds and equities, and I think that was the right call. As you can see, investment grade EM Asia performed at 21.1%, which basically beat the MSCI World, which was 15.4% return. I think the big changes this year is that for equities, we are overweight, whereas we're looking to downgrade investment grade EM Asia US dollar denominated debt. We also think that, we also upgraded China in the fourth quarter of last year, which was very timely for the A shares, but it was, I think, a little late for the H share market in Hong Kong. Better late than never, we still managed to catch the second half of the rallies for those indices. But right now I'm going to move on to the week ahead. So last week we said that in our morning note that Asia has been trading sideways for most of this week. But the S&P 500 was insipidly grinding against the crucial 1470 mark with daily candlesticks putting in a series of long tails indicating reluctance to go lower but preference to go higher. And that very night itself, the S&P 500 decided to break through. And we said hopefully that will spill into Asia, which was pretty much what happened. So if you look at the S&P 500 chart, there you have it, those series of long tails there, and then we had that move above the 1470 on Thursday night, and then it continued on Friday. Okay, so if you want to trade this, because we think it's quite positive, since the 1470 was a very crucial resistance, Phillip CFD has the following CFDs to trade that, and also this is the ETF if you want to long the index. So we're positive on the U.S. It's market weight for us for the U.S., not an overweight. But in absolute return terms, we still think the U.S. will eke out some positive returns. Obviously, in the near term, there's the sequestered debt ceiling, so keep your stops tight. Okay, so the U.S. rallied on Thursday night and spilled over on Friday. So this is what we're talking about. The HSCI broke through the 12,000. So you see this red line here. It's a crucial line, and went above it on Friday. And today, as we speak, I understand that it's also putting in a bit of a positive. It's a positive start of the day for the HSCI. Phillip CFD has that ETF, that's CFD there to trade the index. 2828 is the ETF to long the index. It's physically backed, and our head of Hong Kong recommends, our head of China research recommends China Merchants Bank and Central China Real Estate. The charts for China Merchants Bank is pretty good, although I don't have it here. You should check it out. It's a very nice trend. And Central China Real Estate gained 9% odd last week. Okay, so the same goes for the Hang Seng. It's in a messy resistance zone over here, and so this ride is probably not going to be as smooth. However, we have a move above the 23,500, and I think it will probably be encouraged by the HSCEI. There we have the following CFD and ETF, and head of Hong Kong recommends Daxing Financial and HSBC. Also, the HSBC chart is pretty nice with a good uptrend. Okay, A shares where we called overweight, which was very close to the bottom over there. You would have, I think, put in about 13% return. We think that this one, just like the A-share market, has room to run. And here are the ETFs to long the A-share market: A3188, which longs the CSI 300. 2823 for the A50, and on the Singapore Exchange there is the JK8 ticker, which is the UETF SSE 50. Okay, we're over in Singapore this year as well, and but the price signals over the short term are not as clean, although I think the long term chart looks pretty good. But we think that this week it'll probably follow the US and China. So Phillip CFD has two CFDs there to trade the index, and we recommend the Spider STI to long the STI. Okay, so now I'll move you over to Derrick, who will talk about research updates for the week.
Good morning, everyone. Thanks for joining us this morning. As usual, I will run through the research updates from our team for the week. Let me start off with Season Read first. Travis visited the assets of Season Reads in Japan. He visited 6 residences. Overall, we think that resident property prices in Japan are firming up with fairly limited downside risk. And we also noted that Season Read actually has improving borrowing costs and loan tenure since the global financial crisis. And on a relative basis, we prefer Season Read over Japan Rental Housing Investments, which is a stock listed in the Japan's Tokyo Stock Exchange on yield compression. For property sector update, Brian wrote about the primary sales in December actually defied the cooling measures that were introduced in October, and sequentially, private residential units actually increased by around 30% as compared to November. These strong sales and healthy take-up rates actually showed that buyers were undeterred by the lower LTV limits introduced in October. We also issued 3 reports today. First is Sabana REIT. Sabana REIT's earnings actually beats our expectations. Reval surplus actually boosted the debt headroom for the REIT, and we expect positive rental reversions for this REIT as they renew their master leases. But this would be offset by possibly a drop in occupancies. Overall we maintain our neutral view, but raised our target price to 119. Banking sector can actually issue a report today. We expect the NIMs to decrease sequentially with loan balances within the guidance from the management for this quarter. We expect fees and commissions and non-interest income to decrease sequentially due to seasonal effects and high base effects last year. Overall, we have a positive view on both DBS and UOB and continue to rate OCBC as reduced. Ken actually upgraded on DBS today from neutral to accumulate with target price raised to 16.10, largely due to our view that DBS would benefit from the recovery in China's economic condition, and ASEAN would actually benefit from the spillover effect. Next, we actually compiled our analyst view for this upcoming results season, and we spotted a few trading opportunities which we can run through in this page over here. The first one, profit turnaround plays, driven by seasonal strength and the recovery of its Australia operations. Tiger Airways could actually recover from 6 consecutive quarters of losses and turn in its first profitable quarterly result. While the markets could actually react positively to the profit turnaround, we are still cautious fundamentally, largely due to the hefty valuations on the stock. We continue to rate it as a sell. NOL is expected to report a marked improvement in profitability in this quarter as compared to huge losses of around 300 million in the fourth quarter last year. We expect a marginal profit this year, largely due to 8% year-on-year improvement in freight rates. Second theme that we have here is a strong year-on-year profit growth. One of our top picks in the Singapore market. Those of you who have followed us since our initiation would probably be quite in the money now. We expect Pan United actually to finish the year on a high note with 45% earnings growth, with a very good chance of raise dividends to around 4 cents this financial year. SATS could also report a 27% growth in profits, largely due to margin expansions and higher sales from its aviation business unit. We are also forecasting a double-digit profit growth for SGX, driven by strong growth in the derivatives trading volume for this quarter. The third theme, we highlight a few stocks that could disappoint on a relative basis. Genting Singapore had a pretty good run-up, and our analyst thinks that it could be due to market expectations of strong earnings in fourth quarter. While we expect earnings to be better than third quarter due to seasonal effects, we think that it could still miss expectations as it requires a higher 42% growth sequentially for the casino operations. The next one, StarHub, actually we have a neutral view on StarHub, but we think that it could report significantly lower profits of around 76 million as compared to 93 million last year, largely due to the base effects of one-off gains that were booked in the same period last year. With that, I'll hand over to Ken, who will run through our stock feature today, UOB.
Hi, this is Ken. Today we're talking on the investment merits of UOB and why you might want to invest in a UOB. First of all, UOB has a stable dividend yield. At current prices, it's around 3%. We also expect that there might be potential for UOB to further increase their dividends. Right now, they are giving an absolute value of 60 cents per year, we see potential in increasing because based on the dividend policy, right now it's a bit, on a low side of below 40%, given that the dividends are 60 cents. Therefore, should they maintain their dividend payout policy of higher than 40%, then there might be an increase in dividends this year. Also, UOB may benefit from a growth of the key markets in ASEAN. You can see from the chart over here that this red line representing the growth in the FY12 has been very positive compared to the more normal growth in lower growth in FY11, and we expect that this growth in FY12 to continue into FY13 as the GDP of the forecast of the ASEAN countries remains strong, and also we are more positive on the economy. Also, UOB is well positioned to ride on the ASEAN trade boom. Based on the a speech recently by MTI on the 17th of January, the view is that China's trade with Malaysia, Thailand, and Indonesia is expected to increase to be the top 25 bilateral trade routes in the world by 2030. Given that UOB has significant presence in Malaysia, Thailand, and Indonesia, it stands to be in a very strong position to benefit from the increase in trade. Through this increase in trade, it will be a step. It will be through its current established business relationships and strong trade capabilities. Also, with the opportunities present, it depends on how UOB would execute. How the opportunities are present is because in FY11 there was a deleveraging of Europe ex-UK banks from Singapore and Asia. As this Europe ex-UK banks deleverage, the UOB and the other Singapore banks will be able to enter into the large SME and medium SME segments. Although for the MNCs, the Europe ex-UK banks continue to dominate. Also, as we have said, the FY12 expected GDP growth has been strong, and in FY13 is expected to continue, as you can see on the right hand side. And with this strong GDP growth forecast, we expect this to sustain growth with upsides from increasing traction from these new relationships developed over the last 2 years. On the figure below, you can 2 figures below, you can see the foreign claims on Singapore. It's actually declined negative 11.2% in compared quarter on quarter, and negative 16% quarter on quarter year on year for Europe ex-UK banks. The reason for it being ex-UK is because Standard Chartered is a UK bank, and it may tweak the picture given that it's relatively localized. And also on the Europe ex-UK claim in Asia, it's relatively flat, as you can see. In fact, it's actually decreasing for a few markets like China, Singapore, and India. Also, on the overseas contribution, UOB has guided on its target for overseas contribution. In the wholesale banking segment, in the first half of 2012, it has been contributed 40% of total profits, and they expect this to increase to 50%. In the wealth management segment, it's currently at 26% and is expected to increase to 50%. In corp treasury product, it's currently at 27% and expected to hit around 40% of total contributions. The reason for corp treasury product being lower is because some of this involve FX, and given that some of these ASEAN currencies may be more restricted, like Indonesia and Malaysia, therefore a smaller percentage would likely come from overseas contribution. Management has also indicated that they are confident of meeting these targets above. And just on a quick update on the 4Q results season preview, for UOB, we expect loans growth to be within guidance of around a high single-digit growth year on year. Also, we might see some continued NIMs pressure. This is because the fixed deposit rates have stayed up, and right now actually they're having promotional rates of 1% during the Chinese New Year. And also the mortgage loans pressure remain up. The reason for the mortgage loans pressure is because of constant refinancing. So, for example, should someone have a loan and amount 2 years ago, they would probably refinance it for a lower interest rate, and therefore this has been pushing the margins down. And the NIMS pressure, the magnitude would actually depend on the pricing power that UOB is able to achieve in the ASEAN region. And should they be able to price the loans upward, then the NIMS pressure will be lower. Fees and commission on a quarter-on-quarter basis will be lower due to seasonally lower market activities in the year-end, and non-interest income is expected to decrease quarter-on-quarter from a high base in the last quarter. On why we prefer UOB over DBS and OCBC, just to reiterate, we have accumulate on UOB and DBS and reduce on OCBC. So as you can see from the chart on your right, OCBC has actually outperformed UOB and DBS. However, we expect that UOB and DBS is expected to recover and outperform OCBC in the longer term. Also, UOB has the widest ASEAN geographical presence among the three banks. It has presence in Thailand, which none of the other two banks have, and it also has presence in Malaysia, which DBS does not have a significant presence in. Also, on the valuations, it's inexpensive, and you can see over here that it's actually trading below its 5-year historical price to book at around 1.34 versus 1.37 based on price to book trading 12 months. DBS and OCBC, on the other hand, are trading marginally above mean. Also, we expect UOB to post stable year-on-year growth in net profits. And therefore, we have an accumulate rating. With right now, the price is around 1876. The target price is $20.95. And this is based on a 1.35 times FY13 expected PB multiple, 1.35 times being nearer to the mean, and this being a forward-looking price-to-book multiple. For more information on the Singapore banking sector, you could refer to the report that we have released today. And here's a very quick outlook of the UOB Bank.
Hi, Joshua again. So if you guys have questions, please ask them, and we will try and answer them. There are 69 attendees today, so that's good. If you have questions, go ahead and ask. The whole team is here, so you can even ask some things that are not on the slides today. Oh, there's a question here on Yang Zijiang, but sorry, we don't have coverage on Yang Zijiang. Okay, okay, we have a question about gold. So, yeah, we are underweight gold at the moment. Price action is not good. Also, amongst the although all the major currencies are undergoing a devaluation, in relative terms, actually, we think the U.S. is going to come out on top, and that's the key cornerstone currency. The U.S. will come out on top over the euro and the JPY over the longer term, and I think that outlook is weighing on the price of gold. Also, this year, we've had a lot of stability in the macro environment, and the investment climate has improved substantially, and I think portfolios are looking to long stocks, and the urgency to buy gold is much reduced. And inflation expectations are also pretty well anchored, despite all the QE that we see. So yeah, we're not positive on gold for the year, although we don't think there's a lot of downside to it as well. Gold is a very tricky asset, so we're going to continue monitoring it, and things can change quickly. Okay, so yep, if we have a change in our view of gold, we will definitely issue a report. Now there's a question on biosensors, so I'll put you to Derrick.
Hi, good morning. Derrick here speaking. This question on what do you think of the stock of biosensors, you may want to refer to our report actually that was issued last week, 14th January. Let me just run through some of the key highlights of this company. We do not have a rating on this stock first, but we visited them and believe that there's quite a bit of interest on this company because it's one of the fastest growing companies in the Singapore markets. Let's talk about investment merits first. Following acquisition of JWMS, one of the top 3 DES players in China, we believe that Biosensors is well positioned to benefit from the growing DES market in the country. Successful launch of biometrics in 2008 was actually the key driver of the profit growth in the IVP segment over the past few years. And we think that going forward, earnings upside will likely come from growth in the new markets as the company actually achieves regulatory approval for the use of its products. The licensing revenue for its licensing revenue from Terumo actually is a very steady set of income streams from Noburi, which actually uses their technology for biometrics. So overall, let me just put it this way. This stock is trading at reasonable valuations on a forward basis, but the earnings growth is expected to be high by the market. It's almost like a mental pack, if you put it. If I may put it this way, that Biosensors management actually guided for 20 to 30% growth in revenue and improved profitability for FY13. Hence, what I'm trying to say is that the market expects earnings to grow in FY13. So, on relative to the peers basis, its valuation on a forward basis is around below that of the peer group, as you may want to refer to in our report. I'll hand over to the next question. Okay, I'll hand over to Ken.
Okay, hi, this is Ken here. The question is on our views on DBS versus UOB. Actually, based on our recent upgrade on DBS, we are actually our views of both DBS and UOB is actually positive. This is actually in line with our economist expectations of an improving market, and as we can see, the China economy has actually improved a lot. And then from the improving China economy, domestically, they have been doing very well, and this might actually boost imports. And with this, the ASEAN region is actually in a good position to benefit from the increasing trade flows, and this would actually help in improving the DBS and UOB's profitability, especially with DBS having a very strategic and strong position in China, whereas UOB has a very strong position in most of the ASEAN regions. Therefore, we are actually both positive on DBS and UOB on almost a similar level. On the second question on how does UOB and DBS compare to the Bank of China, ICBC listed in Hong Kong, unfortunately, we do not currently have, cover the, I'm currently only covering the Singapore stocks, and I'm not that well versed with the Chinese and Hong Kong stocks. But my view on the overall picture is that that the Singapore banks are actually of higher credit quality. They are in a way safer investments, and that therefore it remains an attractive buy.
Hi, good morning. This is Brian. I'm covering the property sectors. We have a question on the property sector on what's the view on the sector with developers giving substantial discount to offset the recent government policy. Okay, we are expecting the sales volume for this year 2013 to drop around 20 to 30% and price to correct around 5% this year. But in the longer term, we still need to monitor the actual impact from this policy, because it is multi-pronged, and also it needs a longer time to monitor. And on the developers giving discount to offset their inventory, it could be a short-term impact, because we have seen in the previous round of cooling measures where immediately after the ABSD introduced, the developers will come up with all those rebates and discount to get the investors and buyers back to the market. When times sentiment improve again, developers may take away all the some incentive again. So at the moment, we expect the developers to see their future margin for their new project to be on pressure because of the increased supply of new land, and also because of this new measures to prevent or make it more difficult for the second-timer and investor to buy. And with that, we also prefer those well-diversified developers, such as our top pick, Capital Land, which have a good mixture of exposure in Singapore, China, and also in the different segment of the real estate. It is not solely concentrated to the residential market, but they have exposure in retail, commercial, and service residence. So hope I have answered that question. I will pass on to the oil and gas sector analyst.
Hi, I'm Nicholas. I'm covering the oil and gas sector. With regards to the outlook of oil and gas, it's still pretty robust in this sector, despite the number of deliveries that for jackup this year. We still see strong demand coming from the deepwater segment, whereby there will be demands coming in from the semi-sub areas and drillship, and we see that Keppel will be able to benefit from this increase in the semi-sub demand, as Keppel has a very high market share in this segment in particular, and this will definitely benefit Keppel as a whole. As for the commodity outlook, we are still cautious with regards to this sector, in particular because of the global growth concern, and however we still see that Golden Agri should be able to benefit from any recovery from the palm oil prices, because it is it is considered one of the pure commodity play in the palm oil sector. Hope I've answered your question.
Hi, this is Derrick here speaking. There's a question actually on has the Baltic Dry Index bottomed, and your call on NOL. Let me just put it this way. Baltic Dry Index is an indication of the dry bulk market, so it's very different from what you actually see for container shipping lines like NOL. So it's two different markets. So I hope that our clients will not mix up these two factors. Broadly, they are always a good indication of the health of the economy. If you look at NOL, right, you should be looking at the freight index on the Shanghai Shipping Exchange, which we actually publish quite regularly in our reports. Or you could just give me a call. We can give you a more up-to-date number on a weekly basis. Our call on NOL is actually positive. We rate them as accumulate. Yep, that's all for me. I'll hand over to Ken.
Hi, this is Ken here. Some questions on SGX. First of all, what is our target price for SGX? Our target price for SGX is actually $6.85 currently, and this is actually based on the last results season, and on the recent run-up in price for SGX. Previously our view was neutral. Right now it's actually under review. So as recently there's been quite a bit of increase in trading volumes, trading values, and right now given that we have our stance has actually shifted to a much more positive view on the stock markets, we may need to redo some of our calculations, and based on the results that will be be posted the results that will be released this Tuesday after evening, and from there we will give you an update on the SGX price. At current STI levels, should SGX be valued higher? With regards to this, it's actually more of what would be the number of the value of the trades that are value of trades on SGX, because that would actually drive SGX revenue. So in terms of the value of trade at current levels, actually the prices are relatively high. However, that said, once again, given our more positive view of the equities market, we are actually in the process of increasing our forecast for the trading value moving forward, and this may have an impact on our target price.
Hi, there's a question on HSBC. Actually, a report was released today from our China colleagues on HSBC. Their target price is 95 Hong Kong dollars, which is 10 Hong Kong dollars above the 85 right now with a 12-month view. So one of their main arguments is that HSBC is pretty undervalued and is trading on the low end of the valuation range. Okay, we'll take one last question, which is on Wilmer, whether we're more positive on them now. Hold
on. Hi, this is Nicholas again. With regards to Wilmer, we are actually neutral now, given that this recent rally in its stock price, which actually almost hit our target price now. And we are still concerned with regards to their overcapacity issue, regards to their soybean crushing business in China, as well as the increase in the palm refining capacity in Indonesia itself also. With regards to the outlook for Wilmer, we will have to see its coming fourth quarter report, which will be held next month, towards the end of next month. Regards to Noble, we actually don't cover Noble right now, so we don't really have a comment with regards to Noble.
Yeah, hi, this is Ken again. One question, I think this will probably be the last one from Esther with regards to the Singtel and StarHub. Okay, just to give you just to talk about the background of everything. Singtel recently the price actually declined a few weeks back because of the sell-off. Temasek reducing the shares in Singtel, and actually the price dropped to around $3.15 thereabout, and since then it's actually increased to $3.50. StarHub has actually rallied a lot in the last 1 year due to its very attractive dividend. Even at current prices, it's at around the dividend yield is around 5+%, 5.3, 5.4%, and given that the StarHub has actually rallied so much, the upward potential for rallying is actually relatively limited compared to Singtel, which has not rallied as much, as the dividend payout ratio for Singtel is actually much lower compared to StarHub and M1. On our view of moving forward on Singtel and StarHub, for this quarter, even StarHub is expected to post lower net profit. However, our long-term view is that StarHub would continue to generate. Singtel and StarHub are actually expected to generate stable and strong free cash flow and be able to maintain its current dividends and possibly increase its dividend moving forward. On Singtel, some of its overseas associates has actually done pretty well this quarter, such as and then a lot of analysts are actually more positive on Bahati and AIS. And however, this Singtel is a bit more complicated, as the price would depend also on the amount of losses that it may register from the sale of war rate. Whereas STAR is actually a bit of a clearer picture and simpler picture, whereby investors can actually buy into this stock, and from there they can earn a stable and possibly growing dividend yield of 5.3%. Thank you.
Hi. Okay. I think thank you very much for joining us today, and we hope you could join us again next week, Monday, same time, 11:15, and see you again. Thank you.